So yes, hi, I'm Aristotle with Real Wealth, and thanks for joining us on our Thursday webinar. We do these webinars just about every Thursday. Sometimes we have them twice a week, but mostly just on Thursdays. And today is an educational webinar, and we're going to be talking about an update on lending and financing. We haven't had a lender on for quite a while, and it's great to have Richard Advani. Richard, how you doing today?
Doing great, thank you. It's nice and sunny today.
Yes, yeah. So Richard and I, we actually we live maybe 50 or 40 miles apart from each other. So it's pretty nice out today. And Richard is with Guaranteed Rate. Some of you who have heard Richard before or heard his name, he has been a preferred lender with Real Wealth for many, many years. I think we're going to talk about his stats here in a second, but probably in the last, I think for about a decade now, he's been working with our members. But he's with a company called Guaranteed Rate now. We're going to talk a little bit about his company. And so, yeah, and just an update on lending rates, what type of programs he offers, etc. So without further ado, let's go ahead and get started here. I'm going to read our disclaimer as we always do. This says that the strategies mentioned in the presentation may not be appropriate for everyone, and other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and/or attorneys to discuss your specific situation. And past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. So basically, bottom line, seek out a professional if you have specific questions about investments. So before we get started here, I wanted to also mention that we have some upcoming webinars and events. So our next upcoming webinar is going to be a market update. So we're going to be introducing our newest Cleveland property team, Cleveland, Ohio. And so if you really are interested in cash flow and low price point properties, I mean, we're talking 120 to 150,000 price point properties. You want to stay tuned and register for that. That's going to be next Thursday. And then the Thursday after that, we're going to have another property team market update on Indianapolis, or Indianapolis team will be on talking about their market. And then don't forget to register for our virtual event, which is coming up on Saturday, February 1st. And it's called How to Invest Like the 1%. It's going to be a very long but amazing virtual event. Kathy and Rich are going to be speaking. We're going to have a bunch of our property teams speaking on there. And Richard Advani is actually one of the sponsors. So he sponsored the event, and you'll see his name and things like that on the marketing information. So you will definitely get his information as well today. And then we also have a tour coming up. So we have a property tour. We mentioned it last week on our Dallas webinar. That's going to take place on Sunday, February 26th. I know a lot of you have already asked me and asked us when can I register, and it's coming soon. So don't worry, you will definitely get an email for that. So stay tuned, but that's going to be really cool if you're interested in the Dallas market. And before we actually get started, I also wanted to mention on the far right side of your screen, there is a question box or a chat box. So if you have a question as we're going along here in the webinar and you want to ask something that we didn't talk about, or just anything in general, we're going to get to we're going to do a Q&A session at the end of the webinar here, and we will try to get to everyone's question at the very end. So let's go ahead and jump into it. So I'll go ahead and briefly read this for you, Richard. So Richard, again, he's based in the Southern California area. I live pretty close to him, Richard. He's worked with us for over 10 years, as I mentioned earlier, and he's been working in the mortgage industry for nearly 17 years. He's got a lot of experience. Him and his team can assist with lending in virtually every state, and we'll talk about that. He has a dedicated team of professionals with an intimate knowledge of real estate investments. He's also an investor himself with 20 properties across the country, including short-term rentals. And he's also, which we didn't put in there, Richard's also an F1. Am I saying this right? Is it Formula Drift racing? Is that right?
Correct. Yeah.
Yeah. So he's got a really awesome Corvette race car. So I'm gonna hopefully go out this year and see him race at the racetrack. It's pretty awesome that he's into that. And he's a new father, right? He just had a baby 2 months ago, or about a month and a half ago, right?
Yeah, so exciting times, busy times.
Yeah, you're really busy. Yeah. So again, thanks for joining us today, Richard. So go ahead and take it away and tell us a little bit about Guarantee Rate and what's going on.
Beautiful. Yeah, thanks for the warm introduction, and obviously thank you everyone out there for listening. As Aristotle mentioned, tons of experience as a real estate investor, even more experience as a lender. So jumping into Guaranteed Rate, I'm sure most of you have heard of us. Guaranteed Rate is the third largest mortgage lender in the country. We are a full service direct lender. So we have the ability to offer the low rate conventional 1 to 10 Fannie and Freddie loans. And then we also have the ability to go above and beyond 10 loans with more of that DSCR non-traditional product. Now, Guaranteed Rate closed $116 billion in loan volume last year. So once again, we're one of the biggest players out there. As you may gather from the name, we're known to have really, really aggressive rates and fees. We also have, of course, FHA, VA, and jumbo loans for your primary home purchases. As you can imagine, we handle everything from purchases to refis to equity lines and everything in between.
That's great. And can you tell us, Richard, where does Guaranteed Rate not invest in? What states?
So Guaranteed Rate is pretty much national. My business partner and I have some limitations on states. I think we're at a little over 40 states. Every state that you guys handle, that you guys work with, we can handle. And any states that we're not licensed in, we're either in process of getting licensed or have our partners here within Guaranteed Rate that can assist. So we cover every market you guys are in though as well.
Perfect. Thanks.
Beautiful. So I know most everyone's here is kind of to get the mortgage market update, the interest rate update. It's been a crazy year and a half with regards to real estate and interest rates. Interest rates, if you don't know, are not directly tied to the Fed rate. A lot of people call me and say, well, I heard the Feds are increasing the rate and, we know mortgage rates are going to go up as well. So, firstly, mortgage rates are based on that 10-year Treasury bond. The 10-year Treasury bond kind of peaked out about 2 or 3 months ago, maybe a little longer, in that mid 4% range. And, with that, interest rates for both primary homes and investment homes really peaked out. As a lot of you may know, interest rates for primary homes, for investment properties were pushing about the mid 7s. And, contrary to the past 8 or 9 years where, most of us didn't have to pay points to get a good interest rate, not only, did the rates push up to the mid 7 range, that was also accompanied with a healthy chunk of points. And it made things a little more difficult, obviously, for us as investors to get things to pencil out. The good news is, what we've seen in the last 2 or 3 months is rates have steadily been moving down, which is good. I like a steady progression downward versus a sharp downward turn, because those tend to be a little more temporary. And as we'll get into here in a moment, with the reduction in the Treasury bond, interest rates have also moved down as well. So, you can get an fixed interest rate as an investor all the way up to the high 5s and low 6% range. We'll get into some specific examples here in a moment. But, as a lot of you may or may not be aware, going from the mid 7s to even the mid 6s on a $200,000 plus loan makes a sizable difference in cash flow. You're talking $140, $150, $160 a month difference in cash flow. And as we all know, with where the current market is, with where prices are, and with where interest rates are still overall, an increase of $140 a month in cash flow is huge. So, it's starting to become a better and better time to get off the fence and take advantage of that reduction that we have in interest rates. In terms of what's going to happen in the near future, it's tough to say. I don't want to give an opinion on it just because things are, moving around at such a high rate. But what I can tell you is, we're off the highs. We're still at overall a pretty good interest rate from where we were 4 months ago. And the costs have come down, as well with that. The points have come down. And then, as you can see in the slide, the last point, it's really important to note that, with inflation being so high, and, whether you believe the official statistics or not, we all know it's very high. And even though interest rates may feel high right now, in most situations and by most accounts, official or not, inflation is higher than interest rates, and the real power in real estate, in addition to appreciation over the long term, is kind of the devaluation of that debt with inflation. So they are still quote unquote negative interest rates, with that difference between inflation as well as the current rate that you can get out there. And so that takes us to the next slide. In terms of the overall real estate market, I'm sure a lot of you out there, like myself, have still actively been buying. And if you have, you'll kind of be able to attest to what I'm going to cover here. But if you haven't, and if you've been sitting on the sidelines, it's important to start re-educating yourself on what's happening right now. So, firstly, there's a lot of neighborhoods and areas within the builder and within the Real Wealth Network team that I've been seeing that are opening up now. If any of you out there listening tried to buy a home prior to 8 months to a year ago, a lot of times we were signing contracts well into the future, 3 months, 6 months, a year, even 2 years sometimes, just because there was no available inventory. But also what we saw is a lot of builders and a lot of developers kind of had specific allocations to investors or no allocation, right? They were selling mainly to primary home buyers. And what's cool is, as I've been seeing this inventory come out, and as the Real Wealth Network teams have been coming out with more of this inventory as well, one thing we've seen is, there's unique opportunities for us as investors, not only to be able to buy properties that are, done or almost done here in the near future, but also to buy into neighborhoods that, we may not have been able to before because they weren't selling to investors. And a lot of these neighborhoods are pretty deep on phases to where, there's 500 or 300 or 100 owner-occupied homes there already. And now we have an opportunity as investors to come in and, buy in these neighborhoods. And I don't know how long that's going to last. None of us do. It's all related to interest rates and the overall supply and demand. There have been some, builder incentives coming out as well. So there's a lot of positive factors and a lot of positive programs being put together by, the Real Wealth teams and their builders and developers to kind of push us off the fence, right? And to incentivize us to take advantage of some of these unique opportunities that are out there. I think the long-term outlook for real estate overall is still quite robust. The main thing that drove us to the craziness in the real estate market that we've experienced, the low inventory and the high demand and 10 bids on every home, is the fact that there's a supply and demand issue. And the Fed came in, as we know, and increased rates so much to combat inflation, but also to cool real estate, and they say that openly. And the interesting thing is, right now the Fed and what they've done with rates is the external factor affecting the real estate market. The core fundamentals of why it was so strong, supply and demand, hasn't changed, right? And so what that means to me is, as inflation comes under wraps and as things start to cool and as the Fed starts reducing interest rates and in turn mortgage rates drop, the demand is going to go right back through the roof, but there's not a supply. And it's interesting, I was reading a Forbes article just yesterday, and I'm sure you guys can Google the article, and they're talking about the real estate market and what's going to happen in 2023. And I thought it was interesting because they said we still have such a major supply issue, not only because builders aren't building fast enough like they weren't before, but people aren't selling their homes, right? I mean, a lot of us can attest to that. If you're at a 2.5 or 3.5 or even 4% 30-year fixed on your primary home, you're not going to sell right now. And even though there's not 30 buyers to buy every home, a lot of times there's still 2 or 3. So that the article talked about, nationally, one of the NAR's, National Association of Realtors economists, was talking about, even if we see a 5 to 6% reduction nationally, and the cool thing is they actually note, some markets may actually see an appreciation in values. But I mean, what's 5 to 6% of us? I don't know any investor, including myself, that's investing for the next year, right? We're investing long term. So to me, I think in terms of the real estate market, it's a fantastic time because there's so many unique opportunities. And we're married to the property, we're dating the rate. As rates move down, we have that opportunity to refinance, lower our rates, even and further increase our overall cash flow position. But the last thing I'll say is just logically, economics 101, supply and demand. We have a major supply issue. It's not going away anytime soon. And based on that, I'm still long real estate. I know Aristotle, you may want to chime in something here before we move on, but yeah.
No, that's great information. I was going to say, I totally agree with you on that. Kathy has interviewed, if you guys are podcast listeners of Kathy's, if you're not, you should listen. But Kathy, so Kathy had a guy named Barry Habib, which you might know. He was on her show about 5 days ago, and he's in the financial mortgage industry. That was a really great podcast to listen to that. He was very optimistic about what's going on. And then Rick Sharga, him. He was a great interview a few months ago. So if you want to go back, we have a YouTube channel or we have podcasts. You can, wherever you get your podcast from. Everything aligns with what you're saying, Richard. I mean, everyone is saying there's a major shortage of housing, and it's probably going to be like this for a while, several years, because of everything. I think one of the biggest contributors is the lack of labor. There's just not many people that want to work these days. Unfortunately, there's millions of people that just don't want to work. They want to start a YouTube channel or something, and they don't want to go hang drywall and make 120,000 a year. So that's the problem. That's one of the big problems. It's just that we don't have enough people to work. And so when people complain about how their home is taking so long to build, or it's more expensive, well, it's because a lot of it has to do with the labor, right? We can't find enough people to build these homes, and so it's really gotten expensive, and it's really getting out of control. And I don't think it's going to be corrected anytime soon. So like you said, if the opportunity comes across your desk and it makes sense, the numbers make sense, absolutely you should take advantage of it. So that's all I wanted to say about that.
Absolutely. All right, so kind of jumping into those interest rates, we have a couple examples here. Obviously, rates change daily, but these were pulled today, so they should be pretty accurate. So as I was mentioning, interest rates are really down off those highs. With 25% down, you can, today get into the high fives with a modest amount of points, but even to the low to mid sixes with a low amount of points, 20% down, which really wasn't even an option a couple months ago with where rates and with where fees were, now is an option. And what you will find a lot of times, and run the numbers with your Real Wealth Network counselor, but is 20% down, even though the rate's higher, even though the fees are higher, may give you a little better ROI in terms of your cash on cash return. And then multifamilies, you can see, you can get into the mid sixes with multifamily as well. And what's crazy is a lot of people that I talk to right now who have been on the fence for so long don't realize that, investor rates are in the low sixes, are in the high fives now. Most people still think we're stuck in the sevens. So, these rates are, especially when you look at what a 7.5% interest rate payment is on a $200,000 loan, you really see the beauty of being in the high fives to low sixes. So, it's a good opportunity, a good time to take advantage of that reduction because, we're not quite obviously certain what's going to happen in the near future. And as I mentioned, as we all know, these conventional loans at least have no prepayment penalty. So you always have that opportunity to refinance when rates come down. They will come down at some point, when that is, we all going to wait and see. But you do have that opportunity to refinance when that time comes.
Richard, I wanted to ask you, just for people who are new to financing, explain what conventional loans and what does someone need to qualify? Like, what's your typical conventional, what is a conventional loan, and basically what do people need to qualify for a conventional loan?
That's a great question. So yeah, excuse me, excuse me. Essentially, a conventional loan is a loan that conforms to the guidelines set forth by Fannie Mae and Freddie Mac. And typically these types of loans will have the lowest interest rates available. And, I would say probably 90% of the loans written in the market are conventional loans. Now, conventional loans are also the types of loans where you'll need to fully qualify for and fully document your income. So typically you're going to provide pay stubs, W-2s, tax returns, proof of your assets as well. And we like the total of your debt versus your income to be about 45 to 50%. So broad level, once again, conventional loans are loans that you have to fully qualify for. You have to provide all of your income and asset documentation. They typically only allow you to purchase to have up to 10 mortgages. So you have to put some work into getting them. However, they once again typically have the lowest interest rates. And my general recommendation to investors is, to try to maximize those 10 conventional loan opportunities before you move on or explore different financing means.
Okay, perfect. Yeah, good explanation. And then what's the minimum FICO score for conventional loans?
Generally, for rental properties, you're looking at about 660.
Oh,
So you
okay.
can qualify.
Okay. I thought it was high, like 720 or something. So 660 is not too bad.
Yeah, 720 generally required if you're moving over, a certain number of properties. So, once you have 6, 7 properties and you're trying to purchase more, you'll need to have a certain credit score.
Okay, perfect. And so basically the recommendation would be if you're a W-2 employee and you file tax returns, hopefully, and you can fully document your income, your savings account assets, that is the best way to go. But if someone does not qualify, let's say they're self-employed, they own a business or several businesses, is there life after 10 loans, as the next slide says?
Yeah. So, for the longest time that I've been doing this, I'd say, for 15 of the 17 years I've been doing this, most of the avenues out there the avenues out there were limited, right? We were mainly able to write conventional loans, which means everyone had to fit into this box. And in general, going over 10 was extremely limited and was very difficult to do. So for the longest time, we were all, as investors, as lenders, we were all waiting for, a consistent, good product to assist investors that have already reached that 10 limit, but also help qualified, good borrowers, right? People that had money saved up, that had immaculate credit, that own their primary home, but were self-employed and took advantage of some aggressive tax write-offs. So introduce the DSCR or the debt service coverage ratio loan. So these non-QM or non-qualified mortgages, non-conventional, there's so many different names. That's why I'm kind of rattling them all off, so you realize that we're talking about one and the same thing. Is a fantastic product. So there's no limit on how many properties that you have. So as with Fannie Mae, where you're limited to 10 properties, this is no limit on properties. There's no income documentation required as well. These loans are based on the cash flow generated by the property you're buying. And the general requirement is that the rent at least covers the total mortgage payment on the property, including taxes and insurance. So if the total mortgage property, including property taxes, insurance, principal, and interest was $2,000 a month, they're going to want the property to rent for at least $2,000 a month or more. But the good thing is that means no tax returns, no pay stubs, no income documentation at all, which is phenomenal. I have a lot of clients that are under 10 loans, but still take advantage of this particular program just because it's very easy to get done. Even if you may qualify full documentation, this is something you could consider, if getting a loan seems cumbersome for you. It allows you also to vest in an LLC through closing. It allows you to buy a short-term rental or a long-term rental. It also allows you to, purchase a property with a loan up to $1.5 million. So a lot of flexibility with these programs. You can also buy, single-family homes or multi-units. And as with any program that solves a problem, even though this program is beautiful, you do pay a little bit of a premium on interest rates and terms over the conventional loans that we were talking about earlier. So these loans typically are going to have 2 to 3 points standard. You don't have an option to go below that. And they also typically have a 4-year prepayment penalty, which means if you sell or refinance within those 4 years, you're going to pay a penalty amounting to 6 months of interest. So it's not a ridiculous amount, but it's a decent chunk, and it's something that needs to be factored into your overall exit strategy with the property. But overall, in most situations, leverage is better than no leverage. And a lot of us that have 10 properties and 10 loans already have kind of been stuck in this loan jail, and to be able to get out of that and have the opportunity to use leverage to grow our investment portfolio has been great. And also, once again, for people that may be self-employed or retired. But on that note, just because you're self-employed or retired doesn't mean you can't qualify for a conventional loan. So, have those conversations with myself and my team, because a lot of times, even though you may be retired, even though you may be self-employed, you still could qualify for conventional. But if not, this is a great option for everyone.
Yeah, and like Richard, I'll give an example to the listeners. I think I referred a client to you a couple of weeks ago, and his debt to income ratio is too high for a conventional loan. So this program would work if the numbers worked on the property, right? So would this be a product that you would steer someone? Let's say someone has like a 60% debt to income ratio. I mean, but you might also strategize with the person and say, maybe if you pay off this credit card or that credit card first, and you can get below, maybe you can get a conventional loan. Do you do those types of consulting when you talk to somebody?
Yeah, I would say that's in fact where we really shine. Look, anyone can be the, hey, here's your rate, here's your fees, mortgage lender. That is definitely not myself or my team. We do a deep dive on your qualifications as well as your broad level investment goals, because everyone on my team are real estate investors as well. Interestingly enough, Aristotle, that gentleman you referred over, I don't like to take what other people tell me at face value in terms of their qualifications, because that gentleman ran into an issue where his debt to income ratio was too high, and obviously he reached out to me for this non-QM product. Well, the reason I mentioned is we actually were able to approve him for a conventional loan. His debt to income ratio was way up there, but as you mentioned, with paying off some debt and restructuring a couple things, we were able to take that guy. Look, frankly, that was more work for me, right? I could have just taken him at what he said. He doesn't qualify, ran him down this non-QM path, which is no income documentation. But I wanted to do the deep dive myself, and it paid off for him because we were able to qualify him for that conventional product. So that's actually a great example, to cite. Look, I'm not saying we have a magic wand, but we have proven to be able to get people approved that may not have otherwise been able to qualify. But if not, we have the backup of this program we've been discussing, this non-QM niche program.
Yes, and for the listeners, we have a few people asking what the rates are. We're going to get to that in just a minute here. But real quickly before we move on, Susie was asking if this is a good loan for, or if this is a good product for, if someone has under 10 loans. And I guess the answer would be, it depends, right? Like if they couldn't qualify for a conventional loan, DTI is too high, or they don't have, they have self-employed or things like that. But yeah, you could definitely talk to Richard about your scenario, and he can strategize and see where you're at. But it can make sense. It can make sense, and of course the property has to make sense too. I mean it has to pass the DSCR. What's the ratio? 1.01? Is that what it is now?
The ratio kind of affects the loan to value. You can actually go up to 25% down. I think we cite 30% in the example, but you can go 20. Oh, we have 25% there as well. But you need to meet like a 1.15 DSCR, meaning if the property's rented at, okay, excuse me, if the overhead's 2,000, you'll need to have 1.15 times that in rent, which a lot of properties that we work with do have. If you're at down to as low as 0.8% you could put 30% down. So there's flexibility there in terms of the interest rates and the terms. Back to Susie's question, though, briefly, if you can qualify for a conventional loan, there typically is not going to be a reason to take advantage of this DSCR loan, as you guys can see from the rates. You know, I have some clients that send me their tax returns in like 5 boxes every year, and they're that complex that even though they may qualify conventional, they're like, I'll pay the premium and interest rate to just have to sign it and not deal with, you know, all of the documentation required for conventional loans, given that he's a super, super complex client. Most of you will qualify for conventional, and it's not going to be this big pain. So moving on to the DSCR interest rate scenarios, as you can see from the example here, the good news is that, you know, the DSCR loans have moved down with conventional loans, and, you know, the DSCR loans today have rates of about where the conventional loans were, you know, 2 months ago. So you can get into the mid 7s. They were as high as the mid 8s at the peak. So, you know, it's a great reduction. As you can see, these options are priced with 3 points and a 4-year prepayment penalty. So they are higher on rate, higher on fees than conventional, and they have a prepayment penalty, which conventional does not. But once again, you know, having leverage, having options is better than not having options. And these are really, really easy loans to get done. You know, you do have to have overall good credit, but as we mentioned, they're not going to look at your income. You do have to have, you know, an asset profile as well, you know, down payment and reserves. But these programs are phenomenal, and they've grown to be actually quite a large portion of the business we do. And you know, if you're like myself and, you know, you've been following Real Wealth for a while, odds are you're probably over 10. You know, and it's amazing once again having this support, because 2 or 3 years ago, the programs like this really didn't exist, or they were ARMs, or they were balloons. You know, you'll note that these programs are fixed rates. So still negative interest rates in some scenarios, still a good hedge against inflation, you know, and still a good opportunity to create long-term wealth. And also, as we'll get into here too, and as a lot of you out there are doing, you know, 1031 exchanges. You know, when you're exchanging a property, a high value property in a place like California or one of the coasts into, you know, the central United States, a lot of times you're talking about buying 6, 8, 10, 15, 20 properties at once, you know, which we deal with that a lot. So that's great. But sometimes you need kind of a fail-safe option when you have that many moving pieces. And, you know, when working with us, even if you're qualified for conventional, it's a good idea to work with a lender that has backup plan and options when you're dealing with a complicated 1031 and a lot of acquisitions, because you want to be able to close on everything you identify. You know, and that's where these DSCR non-QM programs also shine really bright. It's, you know, kind of a safety feature and a backup plan to these complex, you know, transactions.
Yeah, great. One last question on this loan product. Do you have to own a primary home? Because I heard in the past you used to have to do that. You have to have your own primary home to do something like this.
That's a great question. So the general guidelines are that you do have to own a primary home in order to take advantage of this. However, there's an exception available, and it's a pretty easy exception to get if it makes sense. The reason why generally you have to own a primary home is they don't want you to use this product to buy a primary home calling it a rental, because you may not otherwise qualify. Now, those examples of the exceptions, if you live in California, right, and you already own rentals out of state, let's say you rent in California, obviously that makes it very easy for the investor of this product to say, oh, okay, well, yeah, okay, they're buying another $200,000 or $300,000 rental in the Midwest. They already have some. Or from a logical perspective, if you're renting in the Bay Area, you're probably not going to go buy a house in Cleveland, right? I own properties in Cleveland, great market. But, you know, so they do, the beauty of these non-traditional programs is they're not conventional loans, right? They have the ability to take a step back and use some logic. So, you know, we have a high volume of clients that don't own a primary home. that do qualify for this program. So, talk to me on your in your individual case by case basis. But if you own no rentals currently and you have no, you own no primary home and you're complete blank slate, it may be difficult to qualify for this no doc program. But it's possible if it makes sense. So come to me with those.
Okay.
All right, so next slide. I can't get a loan because I'm retired and self-employed, and we really touched base a lot on this with the whole non-QM discussion, because this fits right into that same program. As discussed, that program has no limit on finance properties, but also doesn't really require income documentation. So it's a great program for someone who may not qualify otherwise if they're retired or self-employed. There's no limit on finance properties. In general, you do need to own a primary home for this product. As discussed, there are exceptions to it. Actually, it's funny, I made this slide right here initially when we started offering this product, and then realized, there were a very easy exception process to not owning a primary home. Typically, this program requires 30% down. As discussed earlier, it's possible to go to 25 or even 20% down, but it depends on that overall ratio of the cash flow versus the overhead. So, we can talk about that case by case as you bring properties and prospective properties to us. One thing we didn't talk about tons earlier is, this program offers a 30-year fixed, fully amortized, but also offers a 30-year fixed with an interest-only feature, which, in the market where we are today with relatively higher rates, relatively higher values, sometimes that interest-only feature can be the difference between a property cash flowing or not in the short term. It is a 10-year interest-only feature. Then after that, it's amortized over the remaining 20 years. But, once again, if you're self-employed, if you're retired, my process is first to do my diligence and see if you qualify for a conventional loan. If you don't, then, we have this kind of slam dunk product available for you.
Perfect. Hey, on that note, here's a question from Tanya, and she says, what are the pros and cons of interest-only loans?
That's a great question. So, in terms of the pros, it's going to give you access to cash flow in the short term. The payment, obviously, on an interest-only loan is going to be a lot lower than that of a fully amortized loan. And the beauty of it is, with inflation, with rent increases, even very nominal rent increases, 10 years from now, in all reality, you're going to be receiving, higher rent than you're getting today. And what that 10-year interest-only feature allows you to do is have that lower payment for that 10 years, while rents are going up and while the rate market's changing. So, it's a great feature. Now, in terms of cons, typically interest-only loans are going to come with higher rates, with higher fees, as well as we can see from these examples we just went over. It's also going to have, a prepayment penalty. Overall, if you can qualify for a conventional loan, it is going to be your cheapest, least cost available financing to us in the market as investors. But it's awesome having the products available.
Yeah, we get asked that question a lot. And another question, we'll move on here in a second, but since we're kind of talking about loan types, Mauricio is asking about, do you offer ARM products? Maybe you could talk a little bit about, we have one lender that does ARMs, but are ARMs really, since the rates have come down in the last couple of weeks, are ARMs really that lower, much lower of a rate than a 30-year conventional? Like, what do you, so two-pronged question. Do you offer ARMs, and are you seeing, if you don't, then what are you seeing out there, ARMs versus conventional? What are the rates?
Absolutely, and that's a great question, and a question that I get asked quite a lot as well. We do offer ARMs, and however, they don't really make sense. And, as a lot of you may or may not know, ARMs used to be based on this index called the LIBOR, and the LIBOR, is non-existent anymore. So they came up with a new index to determine kind of the rates and terms of these ARMs. And ever since they've done that, typically ARMs are only going to give us 1/4 to 3/8, maybe 0.5% lower rate than a 30-year fixed. And for most of us as investors, taking that additional risk of an ARM really isn't worth it over and above a fixed rate. If you're only talking about a 0.25% or 0.3%. ARMs are and can be a great tool to us as investors, especially if we know we're not going to own a property for a long time. But with anything, you've got to analyze the benefit versus the risk. And in pretty much every situation that we ran in the last 12 months, the ARM interest rate is marginally better than the fixed rate, and the investor ends up leaning towards the fixed rate still. So yes, we offer them. Does it make sense to do them? In my mind, most of the time not. But the cool thing is, maybe that's going to evolve in the near future. So good question. Continue asking it, because at some point I'm sure ARMs will have a big margin of a lower rate versus fixed rates. But in this current market, we're not there.
Okay, good. Yeah, I would think that on a larger loan amount, like let's say, you're buying a fourplex for 800,000 or 900,000, maybe an ARM would make more sense than doing, an ARM on a $150,000 property in Cleveland, right? The loan amount's much smaller. I don't know if that makes a difference or not either, but
it does. That's a very good point. If you're buying a very expensive property, 0.5% on rate could mean the difference between $300 to $500. On a $100,000 to $200,000 property, doesn't mean a big amount at all, but that's very relative. So it's important that you explore every option available to you for each scenario, and don't kind of blind yourself to ARMs either.
Yeah, great. Okay, so what's this next slide? Does it make sense to redeploy equity via cash out loans? Talk about cash out refinances.
Yeah, absolutely. And it's a question that I get asked a lot as an investor by other investors is, hey, I bought this property, man, even if you bought property 3 years ago, you have a lot of equity, but a lot of us have bought property 6, 7, 8, 10 years ago. And, the question comes, do I accelerate my real estate investing journey by leveraging, some of the real estate assets I already have? That way I can buy properties quicker and not have to worry, not have to just rely on, saving up money to buy my next rental. And, so first thing to note is what's available out there for us. And, the answer, I guess, to that question is, if it makes sense, is going to go a lot deeper than what I have on this slide. What I have is the information that you'll need in terms of what's available to actually analyze your situation and your scenario. Right? For a lot of us, interest rates are extremely low today, so you would be refinancing to a higher rate to access some of that capital if you were refinancing your first mortgage. But also it's going to give you an opportunity to create some cash flow with what you buy, right? So when you analyze your scenario, you're really going to have to find the balancing point between those. Am I going to, obviously I'm increasing my overhead on an asset I already have and increasing my risk on that asset. However, it's enabling me to buy another asset and also potentially create cash flows there. So you're kind of diversifying your risk a little as well. But to the slide, right? So you have the access to up to 75% of the home's value, minus, of course, what you owe on the property already. So for a lot of us, that means, there's a lot of properties in our portfolio that we may be able to access, $60,000, $80,000, $100,000. Overall, you may experience an increase on your ROI, right? From having one property generating an ROI to increasing the loan on that, taking out some cash, and then buying another property, right? The overall ROI now that you have two properties may be higher, but that's something, once again, you want to really analyze with, your real wealth network counselor, as well as your lender, to see if it really makes sense to do it. Also, typically to access cash from a property, as we all know, if you sold it, you're going to pay tax on those gains if you did not do a 1031. Whereas if you cash out of a property you're not going to pay tax on accessing that cash. So of course, that's one more thing to consider in your broad strategy. And even with where today's rates are, accessing $60,000 of cash is going to be about $350 to $400 a month. But the question is, can you deploy that somewhere else and generate $350 to $400 in cash flow? And if you can, that's a pretty good swap. That may be difficult in this market, but there are opportunities out there to leverage from your existing properties where it still may make sense. And, I end with saying leverage responsibly because, personally, my strategy has not been pulling all the equity out of every single property I have and redeploying it. Although it makes sense to do to a degree, finding that comfort point and that balance point of leveraging and re-leveraging is going to vary from person to person, right? If you've got tons of capital in the bank, you may be a little more aggressive about re-leveraging because you have, means to weather a storm. So, leverage responsibly, really break down the numbers to see if it makes sense to recapture equity from a property. For a lot of us, it makes sense. For a lot of us, it doesn't. But it's important to know what your options are, right? And there may be a safe way to accelerate your real estate purchasing. But people like Aristotle and obviously the other team members at Row Alpha Hope kind of dial in your comfort level, your risk tolerance, and see if that makes sense for you.
Yeah, a couple of things real quickly on that, Richard. So, I had a conversation a couple of days ago with a new member, and they asked me, so how can I scale up? How can I, if I only have X amount of money, how do I keep buying property? And it does take time, but let's say you buy your first property, and then in 3 years, you do something like this. You pull out $40,000 or $50,000 if you have equity in the home, of course. And let's say at that point you're breaking even on the first property, but you own a second property that's cash flowing, right? But obviously that cash flow is going to pay for your other property, because, well, not pay for your other property, but kind of cover. And so it's almost it's almost like you're getting the same amount of cash flow, but you gain another asset. And I think the strategy is good for younger individuals. Maybe you're already working, you're a W-2 employee, you're not retiring for a long time, and you don't need the cash flow. This is a great strategy every few years, in my opinion. Again, responsible, be responsible, but if it's hard to save up, if you live in an expensive city and it's hard to save up money and capital, this would be a pretty good plan every 3 to 5 years, do a cash out refinance, and then get into another property if it makes sense again. And we talk about this all the time in Nevers, and it's definitely something to consider. But the other thing I wanted to ask you was on these cash out refinances, what's required? It's obviously it's a conventional cash out refinance, so it's the same type of 660 credit score, all that stuff you have to verify.
Yeah, it is a full income documentation loan. Those non-traditional loans we discussed earlier also offer cash out. So if you don't qualify the traditional path, we have other paths available as well. But for most of us, it's going to involve, providing income documentations. Your lender will reappraise the property as well, and you still need to qualify for that. Some people think accessing cash from a property that they already own is super easy because the bank has the collateral, but unfortunately, you still do need to qualify. And one thing to your earlier point, though, about leveraging to buy another property, we all get so caught up in just cash flow on the front end. But one more thing to keep in mind is your tenants are paying down your mortgage balance and your principal on 2 properties now versus 1. And for most of us, we're building wealth through real estate in the long term, right? We're not getting rich overnight. Even if you make a 8% return, that's enough to go out to dinner once or twice, as we all know, but we're investing in real estate for the long term. And, looking at that return on amortization, the back end return is very important too for, the long term. And to your point, if someone bought a property 3 years ago and there's enough 30 or 40 grand equity, for all of us know, rents have gone up too. So, a lot of times you can cash out from the property and get back to your original cash flow position on when you bought the property, because rents have gone up. You cash out, increase your payment. But yeah, good points.
Yeah, absolutely. Okay, great. So last topic is just 1031. So talk about 1031 exchanges.
Absolutely. So we kind of touched on this earlier as well, but my team and I have a lot of experience with 1031 exchanges. For those of you that don't know what a 1031 exchange is, it's really probably the most, if not one of the most powerful wealth builders in investing in real estate. So, typically if you sell any type of capital investment, stocks, bonds, a piece of equipment, you're going to pay, and if you sell it for more than you bought it for, you're going to pay a capital gain tax on it. And what's beautiful about real estate is the IRS has a provision, known as a 1031 exchange, which allows you to sell an asset. For example, let's say you bought a property, 10 years ago for 100,000 and it's worth 200,000 today. Typically, you would have to pay tax on that $100,000 gain. And what a 1031 exchange allows you to do is to defer those taxes by buying a new property, right? So you take that $200,000, instead of taking that gain, you just reinvest it into one or more properties, right? And that tax that you would have had to pay, now you defer it, you push it off, because now you bought these new properties, and in theory you would pay that tax when you sold those properties, right? But you may in the future decide to do a 1031 with those 2 or 3 replacement properties that you bought and defer the taxes even further. And the reason why and how this is a major wealth builder is, it's very easy actually in 20 or 30 years to start with one property and do this 1031 exchange and defer it into 2 or 3 properties. And then 10 years later, those 2 or 3 have gone up, and to create an empire literally out of one property. It's very possible. But one of the more amazing things is if you don't actually ever need to cash out of this 1031 exchange and this wealth, and let's say, over the course of your life, 20, 30, 40 years, you've been, building this machine where, you're deferring all these taxes, you've done tons of 1031 exchanges, and you pass away finally, guess what happens to all this deferred millions of dollars of deferred taxes potentially? It passes on tax-free to your heirs, because your heirs get what's called a step up in cost basis. So when I die, my children are going to inherit all of these assets at market value, right? Their cost basis becomes market value. So they don't pay tax on any gains that existed that I would have had to. So if you kind of get what I'm saying, broad level, you can 1031 exchange into 3 properties, and 10 years later do another 1031 exchange, and all of a sudden you've got this pretty big portfolio where you've deferred all these assets, and you can once again pass it on to your heirs tax free, and all those, at least for the current tax structure, and consult your tax professional. But for current tax structure, I mean, all of those gains, all those deferred taxes, they're gone, right? And that's how you build generational wealth. And that really is the beauty of real estate. And as you guys, a lot of the longer you own real estate, the wealthier it's going to make you. And most of us, we all chase this front end ROI, and we chase this cash flow, and it's great to do that because it evaluates the risk of the investment and helps us compare investments. But it's important to remember that's not why we're buying the real estate, right? We're buying it for the long-term wealth building effect, the negative rates, the inflation, paying down the debt, increases in rents, and so forth. And yeah, the cash flow is great in determining the gauge, but once again, even off 20 properties I own, the cash flow is great, and it's increased with increases in rent, but that's not what I'm using to pay my bills still, and it's the wealth that it's created is what's important. So yes, we have complete segue there, but lots of experience with 1031s. It's important to work with the lender that is used to working with 10, 15 closings in different markets, and understands how they work, because it's important that a 1031 exchange goes off seamlessly. And I think I know you guys at Real Wealth do tons of 1031 exchanges, and it can be this big complicated beast, but the reason why you work with the company as Real Wealth, and you work with the lender like me, is we make it not hard for you. You hire people to do all the running around back and forth with a 1031. And you hire an intermediary and you work with the right people. It doesn't need to be this complicated beast that it is. So it can be very easy to do a 1031 as an investor, utilizing the teams available to you.
Yeah, no, all great points, all great points. So, okay, so Richard, so how do people get a hold of you?
Absolutely. So, email or phone call, that's my direct line. You don't need to go through 800 numbers. And, I have one phone number, business and personal. My clients love it. My wife, not so much. But the best way I'd say to get a hold of me, because I do get a high volume of calls, is typically email first. We'll schedule a call. I think you'll find I respond, typically in minutes, but definitely same day. And typically we'll schedule a consultation call for the following day to determine, your goals as well as the best way to get there.
Perfect, perfect. And then since we're going to go to some Q&A real quickly before we wrap up here, Richard's information is on the Real Wealth website. So when you log in and you go to the resource tab at the top, you'll see a conventional lender tab, and you'll find his information there too. So you can get all his info there. So if for some reason you didn't get it here or you misplaced it, it's all on our website. So so in the essence of time, Richard, let's go and let's do some questions here, because I know we got a bunch of questions here, and I'll try to get to most of them I can here. So Susie was also asking, primary is also used as a short-term rental in a regulated city. Can I do a 1031 exchange for investment loans? I'm not sure if we can legally answer that question, but maybe. But basically, if it's a short-term rental, I think there's a time frame on how long you have to hold it for as a short-term rental, right? Richard, do you know that answer at all?
Yeah, I think they look at potentially the ratio to when it was owner occupied versus when it was rented, and talk to a 1031 intermediary. Aristotle can get you the contact information of a great one, but yeah, legally that's a tough one, really to answer.
Yeah, we have Susie. We have well, Susie and everyone else. We have on our website too, under the resources tab, you'll see a 1031. I think it's 1031 facilitator or accommodator. You'll see we have 2 on there, and so definitely contact them if you have specific questions about 1031. They can answer all this stuff. Ryan is asking best options for someone who has no primary home or investment property but has great credit. I guess what kind of loan product would you recommend?
I guess it depends on if you also have income, right? If you have income, then we would go for a conventional loan. If you didn't have income and don't own a primary and have a history, it would be tough to qualify for a loan. One thing to note, and I'll rattle through it super quickly, but you don't need a lot to make tons of money to buy real estate, right? Buying real estate is based on your debt to income ratio. If you have no debt, right? Let's say you live at home with your parents, you have a $200 car payment and you make $800 a month. It could probably help you buy a rental property. If the property is rented out, you're able to use that income to offset the debt. And if your only overhead's $200 a month for your car payment, you only need to make $450 a month, right, to cover that car payment at a 50% debt to income ratio. And the property you're buying is rented out, covers itself. Real Wealth offers lots of properties like that as well. Yeah, I would say jump on, set a call with me, and we can determine if you'll qualify. A lot of times what I find is people will qualify that didn't think they will. They're like, well, I go to school, I've worked at Subway for 2 years part-time, but I got an inheritance, 3 years ago. If you have no bills and you live rent-free, you'll probably qualify. So.
Yeah, good points about that. I always talk to individuals on the phone about this who are new to invest, and I say, a lot of people, the connotation is, oh, I need to have a lot of money, or I need to be a millionaire to buy real estate properties. And the answer, like you said, no, you don't. I mean, again, if you're going to buy a property for $135,000 in Cleveland, the loan amount is so small that, based on your income, obviously you have to have income, but you don't need to be making $100,000 a year necessarily. If your debt to income ratio is really low, like you said, you don't have any bills, you can definitely, get into it. So again, that's why it's important to talk to the lender first. And that's one of the first steps that we recommend doing as a new member to Real Wealth is if you're interested in buying a property, talk to Richard, talk to a lender, get pre-approved, at least get pre-qualified to see that if you can get financing, then okay, great, then you can start looking for property. So yeah, it's a great point that you make about that. Darlene asks, can you do loans in Michigan, the state of Michigan?
Yes.
Okay, that was easy.
Yeah.
Let's see here. How do you qualify short-term rentals with a DSCR loan? It might be a more in-depth question, but the answer is you can do short-term rentals, you mentioned, right? But I don't know if we have the time to get into like what you need to do on that, but you can do them.
I mean, I'll give you the short, like any DSCR loan, whether it's short-term or long-term, in addition to doing an evaluation on the value, the appraiser also does a rental survey to determine what the property would rent for. Depending on the DSCR company that we work with, They will look at, if the area is predominantly short-term rentals, they will take that into account when determining that projected rental amount that they come up with.
Okay, perfect. Okay. Joe asks, does Guarantee Rate service the loan after closing, or is it sold to another bank?
Generally, we service it, but I think you'll note on your disclosure, typically it does check the box that states we may transfer servicing. So, good question once again. One thing I've noted too, in being in the industry a while, is every lender has the ability to transfer servicing with the Fannie Mae loan, and even though lenders may not, I may say, oh yeah, we don't transfer any of our loans. That could change. The last company I worked with, they hadn't ever transferred their servicing portfolio in a decade, and a year and a half later, they ended up transferring it all. So that's something that kind of a moving target, I would say.
Okay. Lewis asks, can you please talk about HELOCs? We didn't talk about that and where rates are going with them. I'll just say, first of all, I'm pretty sure you don't do HELOCs, and it's really hard to find any bank that could do HELOC on an investment property. I know there might be some credit unions out there that can do them, but most big banks and our lenders, they don't do them. But maybe you can elaborate a little bit on that, Richard.
Yeah, no, we actually do offer HELOCs for rentals. It's just the reason why they're not prevalent is the terms. The terms normally don't make sense, right? Typically, you're looking at 60 to 70% loan to value on a investment property, which we may be at 60% loan to value now as investors asking to access more capital, but to be at 60%, including what you do on it plus the cash out or the proposed equity line, 99% of us aren't there. If you own a free and clear rental property and you're trying to access capital, the cheapest way to still do it is a conventional loan. But if it's an existing property and you really have 60 to 70% equity, so you're at a 30% loan to value, we have an equity line product that could work. But once again, most of us don't fall in that bucket. But also, to answer the short of it, equity lines move with the prime rate. So obviously the rates on them are pretty much the highest they've been in a long time. But also equity lines typically are short-term vehicles. They're variable rates. They do have a period where the payments and rates increase quite a bit after the draw period. So if you're looking for short-term cash, equity lines are great. If you're looking to access capital from a property and not repay it in the short term, then a conventional 30-year fixed first mortgage is generally the best way to go.
Okay, that's great to know because I didn't know that you did HELOCs. But yeah, it sounds like someone has to have quite a bit of equity in there to do that. So, yeah. Okay. Okay, Yukiko asks, this is a great question for you, Richard. You're going to be on the spot for this one. How is your company better than other banks?
Well, firstly, I'm here. So that's a great question, and I'll kind of answer it. I think I'm well suited to answer it because I worked all over this industry. For the first 14 years of my career, I worked at the big banks, right? The Wells Fargos and the Bank of Americas, and I was, top out of 3 in the country out of every company I worked for. And working with a big company like that had its pros and its cons. Some of the pros were we serviced our own loans, and everyone knew obviously the big bank, and you felt warm and fuzzy inside, but it was definitely harder to get a loan, working at these big lenders. And also they didn't always have the best interest rates, right? Then you have lenders out there that are really, really small that, have some flexibility, but there's downsides. They may not have, a large array of products like we do. They may not have, the ability to get aggressive on pricing. The reason why I love Guaranteed Rate is it combines all the good parts of the behemoths out there, the big banks and everything, but it also has all the benefits of the smaller lenders. Our underwriting is very reasonable. We underwrite from a common sense perspective. Our rates are extremely low, much lower than the big banks, and more in line with, the small mom and pop shops, and also, we have the brand, we have the big name, we have the comfort and the technology aspect. Once again, we're 3rd largest in the country out of any company, right? So we're bigger than the Wells Fargos and the B of A's and, a lot of other lenders out there. But also we have the flexibility to offer this huge, vast array of products. At Wells and B of A, we couldn't offer loans to people once, they reached 10 properties. All we could do is conventional. So they had to fit in this box. And, even Real Wealth, you guys work with so many good companies, but they either fit in this box or in this box. And what's amazing about working with us is we fit in both boxes. We do the conventional, we do the non-conventional, we do everything in between. We do HELOCs, and you're not paying a premium to us to work with us. We're known to be the rate leaders out there. And then of course, you bring myself in, my experience as a lender, my experience as an investor. The cool thing is 99% of probably of the, I don't know, 5,000-10,000 loans I've done in my career have been investment loans, and so I have so much hard data. I've seen every single scenario out there, that a lot of times I'll save you tens of thousands of dollars or not hundreds of thousands of dollars in your career as an investor. Just like, the gentleman Aristotle that referred over, who was like, I don't qualify conventional, I have to go non-QM. Well, guess what? We qualified him conventional, saved him 1%. You saw the difference in the rates and fees, right? So we saved this guy on that one deal, probably 50 grand in interest over the course. But it's unquantifiable, I would say. But the biggest thing is I'm honest. Look, I'm to a fault. I'm the honest idiot to where, as an investor, if I know that, man, I just got a 6% loan down the street and I'm offering 7%, I'm probably going to tell you, hey, guess what? You can get 6% down the street. I just did it myself. And I've done that. I worked at Wells for a point where our rates were really high and I sent all my clients away. Call it stupid, but that's who you get when you work with me. The honesty, integrity, the knowledge, the products, but also, really good rates and fees.
Yeah, that's great. Okay, last question here, and we wrap up here. So Patrick says, I have an 800 credit score. I own 2 properties, no primary home, and no job. Any options?
Yeah, that DSCR program would be a great option for you. If you're buying a property that's cash flow positive, you're not going to require income documentation. You don't have the history of owning a primary home. However, you do have the history of being an investor. So we should be able to get that exception for that DSCR loan for you. Definitely reach out to me. But sounds like, yeah, we definitely have a pass for you.
Oh, perfect. Okay. Oh, one last question came in here. Chuck says, can I do a cash out? Wait, can I do cash buy and then take out refinance as a tax deductible mortgage? If yes, I have to do it within what time frame? So basically saying, can I pay cash for a house and then do a refinance? And yeah, what time frame, like seasoning period, would you have to wait, I guess, for that?
Yeah, that's a great question. So there's actually a product that in the market for that. It's called delayed financing. So if you have the ability to take a loan, but you buy a property in cash, typically we can do it right away, right? We want you to come to us the next day or even before you even close on it. In order to qualify for the program to be delayed financing, which is a benefit to you as an investor, because typically it's a lower rate, right? It's not a real cash out rate. We want you to come to us within the first 3 months of buying it, as soon as the next day. If it's over 3 to 6 months, then we will treat it as a cash out loan, which has a higher interest rate than delayed financing. So the answer is immediately. There's a program set up for people just like yourself, and it's important to take advantage of it very quickly after you close on the cash acquisition.
That's great. That's great. So, well, as you heard, Richard's got a lot of great products. So if you've got questions, definitely get in touch with him. Again, his information is on our website, Richard Advani with Guaranteed Rate. So thank you everyone for attending. I know we went a little longer as usual, but great questions. And Richard, always love your expertise. And don't forget to join us for our virtual event, which Richard will be sponsoring. Yeah, Richard, I appreciate your insight again. Thanks.
Thank you for the opportunity.
Okay, take care.